Hello everyone, welcome back to my channel. So in today's video we are going to discuss types of risk part number 2. So the first type of risk is exchange rate risk. Exchange rate risk is a risk that arises due to changes in the exchange rates. So exchange rate risk is usually a risk when there is a changes in the risk we expected. For example, today's exchange rate of Indian rupees to dollar is 74 point something. Assume it 74 rupees. So you expect $1 is equals to 74 rupees. So in future, if this exchange rate gets to decrease, like it goes to 70 rupees, means 4 rupees loss will be there. So considering this exchange rate today, you are going to plan your you are going to plan something that you will convert your rupees in future if this exchange rate gets increased. Like you assume that in certain period of time the 74 will be 78 or something like that, but in the reality it comes adverse, like it gets decreased. The exchange rate gets decreased. There is a fluctuation in the exchange rate. It may increase or it may decrease. So risk arises when there is a decrease in the exchange rate. So that is called as exchange rate risk. Or there can be, if one country is facing financial losses, so they may decrease they may decrease their value, price of the their currency will decrease. So on, the causes can be anything, but the fluctuation in the exchange rates, that is the risk that arises is called as, or the loss that incurs, that is called as exchange rate risk. Next is liquidity risk. So we know liquidity risk. So liquidity means converting into cash. We are converting some documents or some securities into cash. So easy liquidation or easy conversion of cash, that is called as liquidity. So when we are unable to convert into cash, when we are unable to convert those securities, those documents, or it can be our jewelry also, when we are unable to convert on time, if we are unable to convert those documents, those jewelry or some securities into cash, that loss or that risk is called as liquidity risk. Next is country risk. So country risk is a risk which arises mainly due to two situations. One is financial situation, another is political parties. When suddenly there is a change in the government, change in the political parties, like in once a time in our Karnataka government, there was a suddenly, in one night, there was a change in the CM. So the suddenly changes of the government may also affect one state or one country, or financial situation of one country can also bring loss to whole country, that is called as country risk. Next is operational risk. So operation here, in the sense, whenever we are thinking operational risk, so operational risk arises in the field of manufacturing process, where we are converting the raw materials into finished good. It is a kind of operation, or it is a kind of process, we can say. So here, if there is any defect in the machineries, or it is the failure of any process, so whatever the design process is not followed, or the people, the laborers, or the system itself affects from the external things or internal things, that risk is called as operational risk. So operational risk is defined as the risk of loss resulting from inadequate or failure of internal process, that is machineries, people, that is the laborers who are working there, the systems, the system is the design process from external event. So from outside effect, if there is any effect on all this, the machines, the people who are working there, and the designed process that must be followed for the expected outcome, if it is affected from any external events, that is called as operational risk. Next is credit risk. So credit risk we have already discussed. So credit risk is a risk arises due to non-payment of that particular amount taken, or non-payment of loan, that is non-payment of interest plus principal amount and principal amount, or both. So credit risk, it arises, it is faced mainly by the loan giver, they like banks, like financial institutions, like creditors, or the person who has taken something as a pledge. So we are pledging in the normal markets also, the pledgers are there. So all those will face credit risk when the debtor is unable to pay the interest or principal amount, or both of that he is unable to pay. That risk is called as credit risk. Business risk. So business risk is a risk when the expected profits are not met, right? Expected or maximized profits is not met, or we are facing zero profits, we are facing always loss due to changes in customer taste and preference, due to lockdowns, due to strikes, due to increased competition, and also due to changes in the government policy, in tax structures also, all the uncertainties, so which we cannot judge, which we cannot expect in future, those kinds of things, if it is affecting on business and it is bringing loss to the business, that is called as business risk. Next is fundamental and particular risk. So fundamental and particular risk as a kind of reverse type of risk. So fundamental risk is that one which affects as a whole, or entire economy, or large number of persons, or large number of group of people within a community. So in the sense, fundamental means it is affecting on all, as a whole, it is affecting as a whole to a country, as a whole to the world, or as a whole to a community or a group of people. Example here, earthquakes, example terrorism, example unemployment, example war. So war, it affects in a country as a whole or a particular region. It can also affect a community also, and it is also affecting a group of people also. Terrorism, it is also a fundamental risk which affects the whole country. Earthquake, it is a loss or a risk that can affect the whole world also. So that is called as fundamental risk, which is not in our control. Particular risk. So particular risk means it is particular in situation, it affects only one particular individual, not the entire economy, or not the entire community, not the entire country. Example, burning of the house. So if one individual house has burned, means all the losses will be of him only, it doesn't affect the whole village or the whole country. Or if the situation can be either also, like if from one house the other houses are also burned, means it is not particular loss. So particular loss comes when it is fixed to the individual. So individual burning of the house, all the losses will be faced by him only. So one thing, all the types of, to cover all the types of risk or losses, there is one solution, that is called as insurance. So for protecting our house, properties or assets from fire, we have fire insurance. If we want to protect our life, we have life insurance. So all this can be, there is a different kind of insurance available nowadays. So we can protect our asset, ourselves and our properties by prepaying, by entering into a document with the insurance company, by paying the certain premium monthly or decided on the contract. Next is market risk. So market risk, it is relating to stock market. So prices in the prices of the shares or the stocks, changes, fluctuations of the shares, prices of the shares and the stock or other commodities. So it changes. If there is a loss faced due to changes in these things, the loss is called as market risk. Next is interest rate risk. So interest risk, it is mainly decided by the government. So we have studied two types of policies. One is fiscal policy and another is monetary policy. So monetary policy is a policy which is developed by the RBI or guided. It is a government policy guided by the RBI. So in monetary policy there will be rules and regulations relating to the finance sector of the country, like interest rates on each deposit, interest rate of everything, every sector of the government or every government related thing. So government monetary policy will give some interest rate. So if there is a changes or a variability in the interest rate from time to time, or the fluctuation in those interest rate, if you are facing any losses, that loss is called as interest risk. So here we complete the types of risk. So in the coming video we'll start about risk management, the process of risk management, ways of managing the risk, and the process of managing the risk. So this is all about today's class. If you have any doubts, you can ask me in the comments below or in your WhatsApp group. Thanks for watching.